Hello dosto, my name is Deepak and I'm a tax code advisor, and today we're going to talk about QBI deductions. It's a 20% discount IRS gives us as a small business owners, and I think there's a lot of confusion around that. This specific question is from a client who is asking that, Deepak, I'm running a successful short-term rental business, but my CPA is not letting me claim the QBI deduction. What's your take on it? So I'm going to answer that, but I'm going to talk about QBI in general as well. So hopefully that's can help a lot of other people who might not be in real estate, but I'll certainly talk about the realtors. I'll talk about long-term rental and short-term rental as well. So we'll cover all of that in this short video. So once again, those of you guys who are brand new to my channel, my name is Deepak and I run a tax practice. So if you're looking for some help in filing your taxes, or you're looking for ways to reduce your taxes, so if you're looking for somebody who is really good at tax strategies as well as does your tax filing all the way from simple, filing your personal returns to complicated business returns, then I'm your guy. I work nationwide. You can reach out to me from anywhere in the country. I'll be happy to help you with taxes. Now, coming back to QBI. So what is QBI and why is it important? So QBI means qualified business income. If you have a qualified business income, you get to take 20% of that income tax-free. So that's a great benefit. Imagine if you have $1 million income, $200,000 of that is completely tax-free. That's awesome, right? I think everybody will love that. So why is such a big discount? Why is Congress saying that, hey, if you are a small business owner, you can take that? Now, before I answer that question, let's take a look at from a dollar point of view. What does that really even mean? What does 20% discount means in terms of a dollar? Well, it depends on two things. Number one, how big your business is. And number two is, what kind of tax bracket you are in. So those two things are important. So for example, and obviously they're somewhat related because the higher the income you have, the higher the tax bracket you're going to be. So let's imagine that you have a $100,000 income and you're in a 20% tax bracket. So if you take a QBI, 100,000, 20% of that is $20,000. That means you don't pay any income tax on $20,000. So if you're in 20% tax bracket, that's only $4,000 tax benefit for you. On the other hand, let's imagine you have $1 million income and you're in a 40% tax bracket. So if you have $1 million income and you get 20% of that as a QBI deduction, that's $200,000. You don't pay any tax on it. And if you're in a 40% tax bracket, that's an $80,000 tax discount for you. So the higher the income you have, the more tax discount you get. So you can see this QBI deduction can be very, very powerful. So So that's number one. That's how the QBI is calculated. Number two is who gets QBI? Well, in order to get a QBI, you need to have a Section 162 trade or business. And Section 162 trade or business means that you need to have something that has a profit motive in it, like you're not really doing this business just as a hobby. Number two, it has to be a business, not an investment, certainly. And you got to be actively engaged in that business, like a regular business owner is engaged. So those are some basic requirements for us to consider it as a business. So why I'm bringing that up is, let's imagine if you have a long-term rental. Well, if you have a long-term rental, would we really consider it trade or business, or would we really call it an investment? And I think most of you guys will agree that that is an investment, and that's why it is not qualified for a QBI deduction. So that's out. Now, let's talk about a short-term rental. Well, short-term rental could be a qualified business income, or it may not be, depending upon how you set up the business. So some of you guys have a short-term rental, but you don't really spend the time on it. Maybe you just have one rental, but some of you guys might have a multiple rental. Maybe you have 2 or 3 rentals. You're spending 300-400 hours a year running that business. You're actively engaged every single month. For you, that would be qualified for QBI deduction, and you will be able to claim it. So for short-term rental, the answer is yes or no, depending upon your unique situation. Then comes realtors. So realtors sometimes get confused because there is a rule when we are talking about QBI deduction. It's called SSTBs, meaning certain professions that are specifically services related are not qualified to claim QBI. For example, doctors, attorneys, tax professionals, finance professionals, they are not eligible to claim that deduction. Well, good thing is that realtors don't fall into that list. So if you're a realtor, you're good to go. You can make $1 million and still claim QBI. Architect, Again, you're a services-based business, but that limitation doesn't apply on to you. So if you are these professions, that means you are an attorney, you are a tax professional or finance professional, you are primarily a services-based business. Even if you fall into that SSTB category, it doesn't mean that you can't get QBI. It simply means that if you are in that SSTB category and you are also a high income earner, then that QBI deduction start to disappear for you. And limitation for that is quite high actually. For now, it's $383,900 for merit filing jointly. So, imagine if you are a lawyer and you're making $350,000 a year, guess what? You qualify for QBI even though you are SSTB. So a lot of time I meet with people who run real estate, but they're not structured properly, or they run a services-based business that are not structured properly, and they're losing out on hundreds of thousands of dollars in deductions. So we need to be very careful with that. Now let's talk about this managing real estate, because that's where I get a little bit confused, because people tend to mix their investment-related activities with active trade or business. So for example, in real estate, what do I consider active? Well, are you running advertisements? If you're running your own ads, maybe you're putting the ad on Zillow, or you're putting an ad on Craigslist, or you're running a Google ads or whatever. If you're marketing your property, that's good. But if you're giving it to a third-party realtor to market that, then all of a sudden, that's not active trade or business. Who is doing your tenant screening? Who is doing your lease negotiation? If you're doing it yourself, then you're good. If you're having a third party doing it, probably not. Who is collecting rent? Who is managing leases? Who is involved in repairs? Who is involved in maintenance? Who is involved in property improvement? Who is involved in hiring contractors? Who is involved in cleaning? So all of that kind of stuff that engages you in a business makes it an active trade or business, versus if it's, you're just giving it to third party, they're doing it all the work, then that is really a passive activity, more like a passive investment, and you don't qualify for that. Sometimes I see people who are investing in REITs in real estate, so those ones are tricky. Some REITs might have dividends that may qualify for QBI, even though they are dividends. So, that's an interesting one. But for the most part, real estate gets a little bit tricky. So please pay attention to what I just said. Some of you guys might have multiple businesses. That means you have one business that does qualify for QBI and another business maybe that doesn't qualify for QBI. In that case, I will advise you to set up two separate structures, keep your income separate, keep your business separate, let the income drip into your 1040, and we'll calculate it accordingly. So, whatever income does qualify, we'll take a QBI on it. Whatever does not qualify, we would not take QBI on it. So I hope that answered that question. I think this is a major benefit that many people are missing out. So if you have more questions about it, you want to discuss this matter in a little bit more detail, how it relates to your business, if you're, for example, maybe you're doing a lot of trading, maybe you're involved in real estate, maybe you have a services-based business where definition is so clear, not so clear, I advise you to please reach out and set up a consultation, because if you ask for a generic answer, it may not be relevant to you, and you might take a QBI deduction, and next thing you know is you're getting an audit notice because IRS do not agree with you. They might not see you as a qualified business or trade. So we have to be extremely careful whether we take it or not. Now, if you're not a high income earner, if you're making merit filing jointly less than $383,900, then you're good. You don't have to worry about it. But anything over that, when you start taking a lot of income, then we need to start to get worried about that. If there's anything I can do to help you out with your taxes this year, certainly reach out to me via taxcodeadvisors.com. You can always book a free discovery call, and obviously we can always take it into a consultation if we need to discuss matter in great detail. We are a full-service tax firm, so we help you, giving you great tax strategies, and then more importantly, we also help you file taxes. So either way, I'm here to help you anywhere in the country. For that matter, if you're anywhere in the world, you need some help, certainly reach out to me. I'll talk to you next time. Till then, goodbye.